Hello and welcome to Growth Through Acquisition, the series where I interview the leaders of wealth advisory firms in Canada on their M&A journey. On this episode, I'm excited to welcome Ben Wilson from PWL Capital. Ben is head of M&A Architecture at the firm, a role and title that we unpack further in this conversation. PWL has gone through a significant shift in strategy following its announced acquisition by OneDigital in 2025. OneDigital is a US-based consolidator that has acquired over 200 financial services firms across group benefits, P&C insurance, and now wealth management. PWL is embarking on an acquisition-led growth strategy, but as Ben explains, they're not acquiring just for growth's sake. They're looking to partner with practice owners that share their philosophy on index-based investing and financial planning. In this episode, we unpack how PWL has grown so fast to date, what the culture is like at the firm, and how they're approaching the acquisition process, and what ultimately an advisor can expect if they engage in a conversation. This is one you will not want to miss, so let's get into it. Ben Wilson, thanks for joining me. So let's start at the beginning. PWL has had a really interesting history. It's a distinctive firm built on evidence-based investing, and clearly the work that you're doing has been very planning focused. Back in the early years, the vision was all focused on organic growth. Why is that changed now? What is leading you to believe that there's a really interesting opportunity to grow via acquisition?
Yeah, so first of all, thanks very much for having me on the podcast. It's great to be here and have this conversation. But to get into your question, so go back into a bit of the history about PWL. So PWL was founded in 1996, and the current CEO, Cameron, joined in Ottawa in 1997. The other founders were based in Montreal. Then soon after, within a couple of years of Cameron joining, the partners made a conscious decision to focus on a strategy that kind of markets work, take an index-based approach to investing and high-quality planning, and that remains true up until today. As they dove deeper into this approach, the team members at the time caught wind of dimensional fund advisors, and at the time they were not a current player in the Canadian marketplace. And then in 2003, PWL was one of the original firms to help launch the dimensional funds in Canada. And I don't know how many people are aware of DFA in your audience, but it's a high quality fund provider where they take a highly diversified, academically driven approach to investing, and they put more focus on the 5-factor model by Eugene Fama and Ken French. So there's higher concentration in small cap stocks, value stocks, higher profitability stocks. And so that has been a great option for our clients, and since then we've kind of grown organically. In more recent years, Cameron connected with a very high quality firm here based in Ottawa, Shopify. A lot of people know that story, and a lot of the early success came through that. And then following that journey, Ben Felix on our team started his own YouTube channel in 2017 and the podcast, the Rational Reminder podcast, in 2018. It's just an opportunity to share high quality information about good investing, rational approach to financial planning and investing for our clients. And the original vision was kind of like, if we can provide some good quality information for some of our clients, we'll consider that a win. And it's become more successful than we could have ever imagined. And that has kind of opened up this opportunity for us to approach like, okay, we could become bigger, we could become something more impactful in the Canadian marketplace. And this podcast has become popular in the wealth management space across Canada and even globally. And the thought leadership that Ben Felix and Cameron have put out has resulted in a lot of advisors showing interest in what we do and how we approach things. So we just decided like we want to look more at inorganic growth and seeing where we can take it.
Yeah, that's great. And I hear many advisors, many firms mention that you're the envy of the street in terms of your YouTube presence and the audience that you gather from around the world. It's very unique to see a firm like yours really have this approach towards kind of radical transparency. You announced the deal with OneDigital, and in true PWL fashion, ran a YouTube episode talking about it. And so I would encourage anyone who hasn't watched that already to go and watch it. But in a short amount of time here, maybe you could distill what that podcast told the audience about why you chose OneDigital for this next phase of PWL's journey.
Yeah, for sure. So I think the episode you're talking about is where Cameron and Ben Felix interviewed Mike Sullivan. He's the chief growth officer and co-founder of OneDigital. And talked a lot about the story there, but Cole's Notes version is we weren't looking to partner with anybody at the time. Cameron started talking to Mike at OneDigital probably close to 2 years ago now. We were officially acquired in January 2025. They kind of got connected to us through the Dimensional Fund Advisor community, and they were kind of looking for a wealth management platform. We're the first non-US acquisition that they have ever done. And we said no at first. Like we had a good thing going. We were growing well on our own. We had no desire to kind of partner with this larger firm. But as the conversations continued between Cameron and Mike, and he gradually started involving other members of the leadership team in the conversation, it became more and more obvious that it was such a good cultural fit. There was such a big opportunity. And if we combine our wealth management and planning expertise here in Canada with their background in M&A and their economic scale, we could create something much more impactful in the country. And we scoured, did a lot of due diligence to try to find, like, there's got to be red flags. Like, seems too good to be true. And ultimately, we couldn't find anything substantial that would stop us from going through the deal. Got unanimous alignment from our leadership team, and everybody agreed to go forward. This was not a decision made in isolation by Cameron. That's the type of leader he is. He wants to make sure it's the right fit for everybody. And we ended up going forward. They had never been to Canada. They were truly wanting to partner with us and rely on the expertise that we have in the wealth management space. They're actually relatively new to wealth management. They started as an employee benefits firm and gradually grew through M&A into insurance, P&C insurance, retirement in the States, and wealth is more recently in the last 6 years or so. And we are the largest wealth acquisition that they have done. And just the platform we had built really stood out to them, and the cultural fit and alignment for where we were going was key. So we saw that opportunity, thought like it would be really cool to build something unique in Canada, and we're looking to build like what we refer to as an integrated independent wealth management firm. Most of the independent firms in Canada I would refer to as an aggregators, like your CIS Ante or IPC or a lot of these big names that are out there. As a dealer, they provide great back office services, and entrepreneurs have their own business where they have to be attached to a dealer, but they're kind of operating their own business, which is a great model for many people. But we want a team that's truly unified on a foundational philosophy, planning approach, and a bigger vision to impact more people around the country.
So when you think about your role, you talked about it a little bit there, your role in the wider OneDigital ecosystem. Could you see yourself expanding south, for example? Do you see the PWL model becoming global? What does it mean to be part of OneDigital's platform?
Our focus right now is to focus on wealth management growth in Canada. That's what we know. That's where we're experts. That being said, like, the PWL Capital brand has become quite valuable. It's synonymous with high quality thought leadership, high quality planning. The Rational Reminder podcast, that has built up our reputation in the industry. So where we could take that, we're exploring that internally with our team and with the greater OneDigital wealth management team to see, could we leverage that further to make it bigger than what we've currently envisioned.
So you were telling me offline that OneDigital has done over 200 acquisitions, which is phenomenal. You now have access to that mind share and that experience. What does that mean for PWL as you think about and execute on a strategy of acquisition growth?
Because we're outside of the US, we have built up our own M&A team. In the US, OneDigital has a fully formed, dedicated M&A team for all of their different business verticals, which I'm integrated with and shadowing some of them and getting support in different areas of the M&A process. But we are truly leading the process on the Canadian side by finding potential partners, leading the diligence, and then eventually the integration into our team. But because they have done so many acquisitions, they've got a wealth of knowledge. They've experienced what works, what doesn't. Like, okay, we learned this when we made this mistake. Try not to do the same thing here in Canada, or here's some insight that we can provide to you as you grow and approach M&A differently. I think the one thing that really attracted us to them in the first place was that culture is so important. We are looking for the right partners. We're not just looking to grow a big profitable business, and if the economics work, then we're going to go forward. That's not what we're building here. We're looking for a high quality business where we find the right partners that can bring the business where we want it to go.
Yeah, and that's a really good point, actually, because from the outside looking in, it feels like you're all friends.
Yeah.
So how do you continue a culture like that where you all seem to be friends, or at least friendly, in a world where you're bringing all of these potentially different people with different ambitions and intentions into one organization?
Yeah, I think it will be a challenge. Like, as you get bigger, that becomes more challenging, but we're leading with culture in all of our conversations, in all of our interviews with organic hires. That's one of the first filters. Like, are they going to fit with our team? Like, technical expertise can be taught. Being just a good person that aligns, that doesn't have a big ego. Like, we have a lot of smart people on the team, but there's nobody that I can think of on the team that feels like they're the smartest person in the room. Like, everybody is humble, competitive, but wants to make a difference, but not like, okay, we got the best option here and we're going to crush the competitions. Like, no, we can improve, we can get better. How can we learn from each other and collaborate?
Yeah, that's interesting. You talked about mistakes, so I'm going to ask you this question. What are some of the mistakes that OneDigital has highlighted that they would like you not to make? What are some of the areas that they see as kind of banana skins that you should avoid making?
Couple examples from their early history of M&A transactions. There was a few good deals that on paper they were fantastic deals. They're highly profitable, but after they got through the process and started the integration and seen what they were truly like, it was not aligned at all, to the point where I think they ended up unwinding 2 or 3 deals and said, like, this isn't going to work. And since then, I don't believe there has been any others since those early days where they've had to unwind. Like, okay, we just find good people. We just had a conversation with Mike Sullivan the other day. There's 6,000 people in OneDigital, but if you meet any one of them, you'll probably think that they're just really good people. And that has been my experience. I've been to the OneDigital Summit a couple times that has 1,500 people, which is a lot to take in. But everybody you meet, they're great. There's nobody that sticks out as a how did they get into this organization?
Yeah, that's very unique. 6,000 people. So you have a very unique role in terms of its title, M&A Architecture. Mm-hmm. What does that mean? What does architecture mean for you as an organization? And then what does that mean for you as an individual?
Yeah. So maybe I'll give a bit of background of how I got here. So I the industry on the compliance side of the business. My dad was an advisor. He was actually an advisor with Cameron Passmore in the early 90s. So I've known Cameron most of my life. And then along the way, we've just remained family friends. My dad and Cameron connected well, but ended up taking different paths with different firms. And then I got into the compliance side of the business early in my career. learned a lot about what goes on in the industry. I learned about approaches that I wouldn't want to take in a business, and got to a point being on the other side of the fence where I'm actually working with clients and making an impact is where I want to be. So I ended up connecting with Cameron, and it worked out. He hired me as an advisor in 2017 and went through the advisory role working with Cameron and Ben for a while. Eventually moved into a leadership role to build out our current client experience team over a few years. And then in early 2025, after the OneDigital transaction, I became the head of M&A Architecture. And that word architecture is intentional. So internally, we use the term deal architects. They're the people that are structuring the deal, going through the diligence, and making sure it's a good quality fit with PWL or OneDigital. So I'm involved in everything from helping to source the deals, the discovery calls, getting to know and understand the practices of the different advisors that we're speaking to, and then moving to LOI and eventually diligence and closing the deal. So that's how we've structured it internally, and it's worked well so far. We're only less than a year and a half in, but it's been an exciting journey so far.
I'm going to steal that term now. I'm going to start calling myself a deal architect as well. I think it's a lot sexier than M&A advisor or investment banker. I think when we went through the financial crisis, the word investment banker became a little bit of a taboo word. So
exactly.
I might steal it from you. That's great.
Yeah,
That's
sounds
really
good.
interesting. And I think, honestly, that the uniqueness of being internal as part of a M&A specialist, it is very unique. I've spent some time as well internally within an asset manager, and different to being an investment banker who's focused mainly on the bit before and up to the closing of the deal. It sounds like you're really focused on the full evolution and life cycle, including making sure that deal's a success. So
For sure.
That takes me nicely onto what does an ideal acquisition partner look like. You talked a little bit about culture. In fact, you've given a really good example of culture. But you've announced 3 deals so far. I understand you also have a few more in the works that may or may not be coming to announcement stage imminently. Talk to me a little bit about what a good acquisition target looks like for PWL, and go into things like what that looks like from a client segment perspective and planning capabilities and all those things that you're known for.
Yeah, so we closed, as of the recording date today, we've closed 3. And by the time this episode's out, I believe there'll be 2 more that have been announced. So exciting journey so far. It kind of picked up faster than we expected, and hoping that the momentum continues to build. But we're not just looking to build to get bigger, we're looking to build to get better. Like, one of our like initial screening questions internally is like, is this partnership going to make the firm better in 10 years from now? And if that answer is no, it's clearly not going to improve. Even if the financial economics are there, that's not the driver. It's like, we want to build quality, not profitability. So in terms of ideal acquisition partner, like, that starts with our investment philosophy and planning approach. That's pretty key to what we have built. If you're not aligned with the market's work and planning matters foundational philosophy, then it's probably not going to work. In most cases so far, it has been people that have their client portfolios invested in either DFA or index funds primarily. Doesn't have to be 100%, and doesn't even need to be there yet if you're proactively thinking about, okay, this is the better way to manage client portfolios. We're willing to partner and help you with that transition to move in that direction. The high quality planning, we're been historically a very analytical, data-driven team that wants to give a custom answer to every client and do it properly. We don't provide anecdotal advice typically. It's, okay, look at the client's personalized plan to see how we answer a specific question that comes up. So it's really providing thoughtful advice to clients, and we want people that think in that same way. And people that are truly looking after the best interest of clients, advisors that feel tension with incentives, those are the type of people that are probably going to fit well with us. There's a lot of conflict of interest in our industry where people are paid by product or paid juicy commissions on the insurance side. It's like a lot of those people, I truly believe that they feel they're offering good advice, but it's hard to separate that good advice when it comes with a very big paycheck for you as an advisor. To say other advisors or our model isn't a good competitive model from a compensation perspective, but we're not directly paid by products, so we're not incentivized to sell any specific product. It's like, I don't know if there's a specific client segment or size in particular. It needs to be a large enough book to make it worthwhile on the legal and tax diligence side of things. But we want people that are looking to build something that lasts beyond themselves. The mission we're looking for is like, what impact can we make long term? Scaling your own business is hard. And eventually at a certain size, scaling a business requires you to spend more time on building infrastructure like HR, compliance, operations. And that may be, in many cases, the part of the business that doesn't excite an owner. The part that brought them to the business that they're passionate about is to provide good quality advice and build relationships with clients. And we get to that point in your business, partnering with someone that has already built the infrastructure that can help take that load off your shoulders is helpful. So we've built a platform that people can tap into and become part of. And then not just a platform, but we've built this collaborative team where advisors can build up and learn from one another. Like example, like internally we have a Microsoft Teams chat or weekly advisor calls where advisors come together and share ideas, or I've got a complex planning problem that I'm not sure what to do here, or I've approached it this way, how would you approach it? And then you kind of just have this mind meld to provide the best quality advice to clients, which is better for client experience, but also better for our team collectively because we're making each other better along the way.
So if I can characterize what you said then, culture is important. Collaboration and teamwork here is the way to win. And the power and the strength of the collective will help each advisor to win for their clients. When you think about what to define this as, others have defined it for you as a corporate model. How would you react to that? I mean, there's a lot of connotations that come with it, including maybe correctly or incorrectly that an advisor joining PWL would go from a grid model to a salary model. Is that correct? Is that true in terms of the economic picture for somebody joining PWL?
Yeah, so the model that we're building is we would be acquiring the book, PWL would own the book of clients, but in return, you're paid a multiple for your business. That depends on a number of factors, so I don't have a specific formula to apply here, but typically you get an allocation of cash and equity in OneDigital, and that kind of allows you to participate in the future growth of the company. Advisors or team members that do come in would be salaried employees, which is often kind of a dirty word or a scary concept for independent advisors. But we really try to maintain that entrepreneurial spirit. Like we are finding advisors that have built successful practices that want to be part of something bigger, and we don't want to prohibit them from contributing to that growth. We want to let them do what they have done to get themselves successful, but do that in a way that collaborates with a bigger team so that we can make a bigger impact than we could have separately. And there's other economic incentives that make it worthwhile, and we've built some models that we can go through with anybody that is interested. But I think it's a compelling model, especially in this industry where there's a lot of advisors approaching retirement age. There's a lot of pressure to build infrastructure and technology, and doing some of those things on your own can be quite challenging. So it's an opportunity. It's a different model than a lot of those out there, but I don't think most people internally or any would refer to our culture as a corporate culture. Like, I think we still, even though we're growing to a bigger size, we still have this very close, tight-knit culture of just there's this personal connection and excitement and drive that is very similar to a entrepreneurial boutique type firm, even at our larger size.
So have you built a model to educate advisors on what the enterprise value opportunity looks like in building together in a collaborative approach? And how much of that discussion comes into the thinking and the rationalization of somebody who says, I've got big offer from X dealer and I've got offer from PWL. They're different and I need to understand which one could be potentially better for me in the long term.
Yeah, so we've definitely built a model to compare like their status quo to what the potential could look like within the PWL model. And so we customize that based on their revenues and EBITDA margin and come up with potential projection. And as we're data driven, we also tend to stress test that with a Monte Carlo simulation so it's not just straight line and looks all rosy every time. But I would add to that it's the equity piece. I think there's another opportunity there that kind of changes the risk profile of an advisor. When you are independent and own your own book, you take on all the risk. Like, yes, there's upside, but not everybody can continue to build on an exponential basis where they're adding true net organic growth, net of markets, net of transfer outs. And can you grow your business at the same rate that the equity would expect to grow? And the other side of that is it's equity in OneDigital, which is a business with a diversified business lines. So there's employee benefits, P&C insurance, the retirement, wealth. There's some HR consulting firms. So where wealth is very influenced by stock market cycles, there's some insulation there for employee benefits. We're constantly growing by M&A. So you're not relying on your own efforts and the market condition to change the value of your business. There's a collective effort that could provide a lot more value than you could get on your own. It's not guaranteed, obviously. There's nothing guaranteed in private equity, but I think there's a pretty cool opportunity there when you are participating in equity of a larger firm like OneDigital.
Yeah, that's interesting. A good way of describing how being part of diversified financial services does take some of the risk of cyclicality out of the equation, which is, again, testament to the way that you manage portfolios for clients.
Yeah.
So I'm going to push you on this, and you can share whatever you're willing to share, but most people will want to understand a framework for the kind of multiples that you pay. You talked about revenue and EBITDA. I think for most advisors, they don't think about EBITDA. They really think more about revenue multiples. But if you're willing to and able to share some more information on how you approach multiples.
Yeah, so when we're looking at deals, we kind of look at many different factors. We look at the book size, we look at their revenue and expenses pre-PWL and post-PWL, what that would look like. We're also trying to align fees on the PWL fee grid as much as possible, both for operational consistency, but just out of fairness for clients. Like, if one client is getting service at one rate that's very similar to another client, they should be paying the same value. There's an inherent conflict if people are paying the same price or different prices for similar service. And we're looking at different things like product characteristics in their book. Is there some products that create higher risk that can impact the multiple? The demographics of the book can impact the multiple in some ways. So we're kind of evaluating all the benefits, all the growth opportunity, the risks to kind of come up with a deal structure. We usually present a revenue multiple because that's easier to understand, and the EBITDA side of things, especially in independent practices, can be debated one way or another and fluctuate depending on opinions. So we evaluate EBITDA internally in a way that makes sense for us, but we have been so far doing revenue multiples when we present it to advisors, and that range can depend on the number of factors that I described. So there's no exact formula, but we want to be fair and competitive and don't want pricing to be the barrier to a great partnership.
I've been doing a little dissecting of the deals that you've done, and it seems like the majority of the deals so far have been what I would term mid-career advisors, folks who got potentially a long career ahead of them. But the most recent deal you did, if I can characterize it this way, would be with somebody who's more likely to be thinking about succession than future growth. So how do you think about succession? Is the deal different for an advisor that has a near-term goal of stepping back or retiring to those that are thinking, right, I want to grow with PWL for the next 10, 15, 20 years?
Yeah, I think it depends on the advisor. The recent deal you're talking about, the advisor might be closer to retirement age, but still excited about what's ahead and wants to be part of the journey for 5+ years to come, possibly longer. So I think it's really finding the people that are aligned that makes the most sense. Like we're not necessarily focused on one demographic or the other. We're focused on alignment from a philosophy, cultural perspective. Like what does that look like? Mike Sullivan often says we're looking for people that aren't in the fourth quarter. We're looking for people at halftime. That doesn't necessarily mean mid-career. It's like people that have gas in the tank that want to be part of something bigger. That's partly why we want to include equity in the deal. Like if you have equity, you got skin in the game. So you have an invested interest in helping to make the company grow. If the company grows, then everybody benefits. And people that want to grow organically beyond their business as well. Like inorganic growth and M&A is great and brings the business value up quickly, but without that organic growth rate following, it's not going to be a healthy business. Like a healthy organic growth rate is a key indicator of a good quality business, and we want to focus on maintaining that organic growth as we build up the business.
I could not agree more. You said it exactly how I would say it. So I appreciate you saying that to the audience, because I feel like sometimes I'm preaching to the unconverted, and it's hard to tell people, hey, focus on the organic growth, and the inorganic growth will follow, because you'll create a honeypot that people want to come to because they're trying to figure out how you grow so fast organically.
Well, exactly.
So we're almost at the end here, and I'd love to give you an opportunity to share with the audience, what does the long-term vision look like for PWL? And maybe even put some parameters around it. So internally, have you talked about where you want to go? Are there any measures that make meaningful sense to you? You know, for example, I've had other guests on here give a BHAG, AUM goal, AUA goal. Like, what are you measuring success on? And since you are a very analytical organization, what are the financial measures that mean most to you, putting aside what you said about great people growing together?
Yeah. So I touched on it a little bit earlier, but this industry in Canada is very different from our neighbors in the States, where it's dominated by 5 or 6 big banks and a lot of large insurance companies. So the lion's share of the wealth is held with those companies. So I think there's a huge opportunity for independent, high-quality planning to follow the trends that we've already seen in the States. There's a lot more market penetration into index funds in the U.S. than there are in Canada. So that in itself is an opportunity, and providing like full-service quality planning to more Canadians that might be at the bank but not realize that the bank's not giving them quality planning. In some cases, some of the bank brokerages, I don't want to disparage everybody at the bank and paint everybody at the same brush. There's some very high quality planners there, but at some of the bank branches, it's not the level of advice and service that everybody deserves. So I think we have a goal, and we deserve or have this opportunity to become much larger. We've talked about growing tenfold to a $50 billion firm in the 5 to 10 year range. Like, who knows what's possible, but we have ambition to grow. Like, one of our company core values is compete fiercely, remain humble. We are competitors. We don't think we're better than anyone else necessarily, but we want to continue to improve and provide the best quality advice and build the best business that we can to serve more Canadians.
That's great. This is a fantastic conversation and really fascinating to hear how you're thinking about growth through acquisition. I saw that you're recently running webinars for advisors who are exploring what's next in their financial practice. Is that the best way to get in touch with you, Ben? Is it better to reach out to you directly? What's the way that somebody could start to learn more about PWL and how that could impact and potentially work for them?
Yeah, so we've been running monthly webinars. I think we have them scheduled out for at least until the fall this year, and depending on how they go, we'll continue that beyond September. So you can definitely attend the webinar. You can tap into our content, like the Rash Reminder podcast. If you haven't listened, encourage you to check that out. Ben Felix's YouTube channel, or I can send you a Calendly link to put in the show notes, and people can feel free to reach out anytime.
That's great. Thanks, Ben. Fascinating conversation. And I'm looking forward to watching on as you announce a few more deals in the near term and hopefully many more deals in the long term. Thanks so much for joining me here.
Yeah, thanks for having me. It was great.